Welcome to Yahoo Finance's flagship show, The Morning Brief. I'm Brad Smith alongside Madison Mills. Let's get to the three things you need to know today.
First up, U.S. stock futures little changed this morning under just a touch of pressure ahead of a big week of corporate earnings. $20 trillion worth of U.S. companies will report results in what is the busiest earnings week for the S&P 500. Among the companies reporting are four of the so-called Magnificent Seven stocks, with Apple, Amazon, Microsoft, and Meta all out with the results.
Plus, investors will also be keeping a close eye on economic data this week. On deck, we've got GDP plus PCE data, finishing out the week with April jobs report on Friday as well. The monthly U.S. employment report for April follows an unexpectedly strong result in March, where the U.S. added 228,000 jobs.
And this week marks the president's first 100 days in office. The S&P 500 index down about 8% since Donald Trump's inauguration, on track for its worst run during a president's first 100 days since Gerald Ford in 1974. Of course, that followed Richard Nixon's resignation. It's a U-turn few on Wall Street saw coming after 2 straight years of over 20% gains and what was expected to be a pro-growth agenda. Instead, markets swung wildly as Trump slapped tariffs on basically every country where U.S. companies operate, and then suspended some, carving out exceptions for certain industries and ratcheting up the trade war with China.
U.S. stock futures up fractionally this morning ahead of a big week for investors, spanning big tech earnings, the April jobs report, and more. Here to break down the biggest items on the agenda for investors, we got our own Josh Schaefer. So let's just kind of line up what's on the docket here, Josh.
Yeah, Brad. So like you said, it is really a massive week, both from a corporate perspective and an economic perspective. I'll start with the corporate side. I mean, we're looking at, I think, about 180 S&P 500 companies expected to report this week. You guys mentioned you have Apple, you have Meta, you have Microsoft, you have Amazon, those coming later in the week. You also have Coca-Cola, some consumer-facing brands. Eli Lilly, also a very large weighting in the S&P 500, will be reporting this week. And then, guys, you shift over to that economic data side. There's a lot this week. So you're going to start tomorrow with JOLTS, jobless claims will come later in the week. But Wednesday, I think, is going to be an interesting one with that first quarter GDP release. Right now, consensus expecting GDP only increase 0.1% in the first quarter, which is rather interesting because, again, the first quarter is largely before the tariffs came, right? The first quarter would have ended at the end of March. So it doesn't really include a lot of the tariff back and forth necessarily, but still maybe not a strong GDP report there. I think that's going to be an interesting one to watch. Then, of course, you have the April jobs report on Friday. Largely, I think economists have argued that that jobs report will not show a lot of impacts from tariffs quite yet, and they're not expecting to see a large slowdown in the labor report that we get on Friday. So that sort of puts the risk, I would argue, perhaps to the downside if you get an uptick in unemployment or a weak jobs number. Of course, we're sort of looking, I think, at this point for further signs of weakness in the economy seems to be the theme overall.
It also sounds like, from what you're saying, Josh, that the impact of tariffs could become more clear through the earnings than through the economic data for now, just because of when the data is falling. Talk to me then about the market impact that some of these earnings could have if we do start to get clues about the economic impact, consumer backdrop from these earnings.
Yeah, I mean, you think about just the four big companies you're going to hear from that have really sort of led the sell-off, right? And when we think about this sell-off and sort of what's been the action, it's been a lot of tech companies, right? Apple has sold off significantly. Meta maybe a little bit less so. Microsoft also been under pressure, and so has Amazon. So I think the question will be, can these companies say anything that really sort of comforts investors? We looked last week, Mag 7 had their best week since 2023. Big rally, and then you take a look and you zoom out year to date, these stocks are all still down. They're all still very far off 52-week highs. Alphabet had okay earnings last week. Markets seem to generally like it. The stock closed up 1% on Friday. So it's not like you saw a massive rally out of that, and I don't really know if that's what drove your rally on Friday either. So you haven't had a full sentiment shift in terms of how people are sort of looking at these companies, it doesn't seem like. What you've had is just a lot of move off the bottom. And so at some point, how do you get an incremental move higher? It would probably be, A, these companies tell you something more comfortable than you thought, and B, you don't get any policy whiplash this week. We kind of avoided that last week, which was surprising. I feel like that was the first time in basically since the start of April that it didn't feel as noisy, and if there was noise, it was maybe beneficial. So you sort of combine those things, and it still feels like a little bit of a cloudy picture to some extent, I would say, but we'll see.
From some of the reports and analysis that you're sifting through, Josh, just on that note of feelings versus fundamentals, how are we seeing that kind of prevail as a lot of firms are really trying to just parse through where the real earnings have come in versus where some of the feelings that are knocking around in the market are standing?
I mean, the feelings are still bad, right? We know that Michigan consumer sentiment was out Friday. It's one of the worst readings on record if you go back to 1978. It's just incredibly low. You're going to get consumer confidence tomorrow. No one expects that to be good either, right? You sort of shift that to a story I did over the weekend. I was asking economists, when are we going to see that in the data? So to a point about the data that's coming out this week, largely economists think you're not going to see it shift to the hard data until maybe May, June, once you start to get readings from May or June, so it'd actually probably be June or July. So you're sort of waiting to just see how bad it is, essentially, right? We know that the data is probably gonna come in weaker at some point. The question is how weak? And I think, again, that brings me back to this week, that GDP print, I think is gonna be interesting because that's kind of where the economy was left off before the large impact of tariffs. So if we were already slowing at a significant pace, or close to slowing, I should say, 0.1% is positive. But if we were close to slowing, it makes you wonder sort of where things head from here, I think, to some extent.
And all of that cloudiness is what leads to me spending my weekend looking at trucking data in California instead of any of the broader headlines that
There's less shipments coming in the LA ports, Maddie.
Exactly.
People are talking about it.
They're panicking.
People are talking about it.
All right, Josh, thank you so much. Appreciate it as always. Well, investors are awaiting earnings reports from U.S. companies totaling $20 trillion in combined market cap. So what are the biggest headwinds and tailwinds to watch for this earnings cycle? Joining us to discuss, Jack Manley, J.P. Morgan Asset Management Global Market Strategist. Jack, great to have you in studio. Thanks for being here. So the market action right now, to what extent do you feel it's going to be driven by earnings in lieu of trade negotiations, given that we are not getting those headlines at this time?
Earnings are always going to be important, especially for long-term market prospects. But as Josh just mentioned, right, so much of what's going on right now will likely only be realized several months down the line. The numbers right now, from an earnings perspective, seem to be shaping up pretty good. I mean, pretty well. They're actually looking better than they did at the start of the quarter, at least for a year-over-year growth, from a year-over-year growth perspective. What I'm very curious about is forward guidance, particularly from those quote-unquote Magnificent Seven. When we do look at the market, Josh again mentioned this earlier. So much of the sell-off has been driven by this very small handful of names that, in turn, did most of the heavy lifting in 2024 and 2023. And the valuations that you saw in those names made them extremely susceptible to shocks like the ones that we are seeing right now. And when you think about a handful of those Magnificent Seven names, right, we think about some of the smartphone manufacturers, for example. Think about how many smartphones these companies sell to China, and think about how many of these smartphones are made in China, right? There are sort of two different exposures to regions that are being, that are sort of in the crosshairs, I guess I'd say, for tariffs that make the Magnificent Seven particularly vulnerable, right? So that forward guidance, I think, is going to be just extremely important right now. And frankly, I think a lot of businesses don't really know what to expect in the near term, which is a little bit concerning.
So with that in mind, how will that forward guidance really kind of cater more to the prevailing thought around fundamentals that we were discussing versus some of the severe feelings that are rattling around in markets right now, which is something that certainly has been playing out even within some of the pullbacks, but yet earnings coming through, and we're still seeing, I think, what FactSet had looked at in continued quarterly growth in earnings profit, at least at this juncture. Yeah,
I mean, we have to remember that at some point sentiment becomes reality, right? If sentiment sticks around for long enough, it will sort of beget whatever it is that you are concerned about. The question, I think, is how long it takes to get to that point, and do we get a little bit more clarity on policy before we hit that sort of tipping point? And I guess I could say I'm crossing my fingers and saying I hope so, but
we all are.
Yeah, I mean, we're all crossing our fingers, but I don't actually know. The fundamentals right now, to your point, Brad, are looking pretty solid. And the story that I'm looking at right now is not necessarily these specific numbers, but the relationship, to bring it back to the Mag 7, between the Magnificent Seven and what I like to refer to as the S&P 493. It's that 500 name index minus the Mag 7, and how they are performing relative to one another. The S&P 500 down maybe roughly 10% or so year to date. I don't remember what the exact number is. The Mag 7's down double that. The rest of the market's not really down much at all. And when you look over to what's going on in the earnings side of things, analysts at the moment are calling not just for the worst year, quote unquote, for Mag 7 earnings since 2022. They're also calling for the best year for the S&P 493's earnings over that same time period. And so that proximity to earnings parity, the fact that earnings growth is set to look more or less the same for both of these components of the market, that's what I think is a lot more interesting than the specific numbers themselves. So I expect to see these numbers get whittled down. There is so much uncertainty. Confidence is not particularly good, but where the whittling actually happens is going to matter a whole lot. And as long as this dynamic of positive earnings growth across all components of the market plays out, then I think we still have a pretty wide opportunity set as equity investors.
So what do you do with the thesis that you just laid out as an investor? Do you buy more Mag 7? Do you hedge against it with the other 493?
Yeah, I mean, the gazillion-dollar question, what do you do about all this stuff? Admittedly, very difficult. The way that I've been thinking about it is, if indeed we are fishing in this much bigger pond, right? It's not just 7 names, it's a whole 500 name index if you limit yourself to the S&P 500, which for what it's worth, I think is what you should be doing. I'm not much of a small cap guy right now. I think there is a big temptation, Madison, to your point, to cut out the Mag 7. I would not do that. I mean, we are still looking at positive earnings per share growth for the Mag 7 this year. These companies are not companies that got cooked up in some guy's garage a couple of weeks ago, right? These are long-standing companies with enormous balance sheets, proven track records of innovation. You do not want to be shorting these names at all, not to mention the fact that tech is a long-term secular trend. So it's not about carving out the Mag 7. It's not even about pitting value versus growth, which is another thing that I hear a lot right now. Surely this must be a more value-oriented market. But when you are talking about 493 names that haven't really done much of anything over the last 2.5 years, they're going to be growth names in those 493 and value names in those 493. So it's not a style box play either. We're always big proponents of security selection, of active management, and good active management always seems to be worth the price of admission. But I think at this very moment, given where valuations are, given where sentiment is, given how uncertain macro conditions are, policy is, what's going to happen with interest rates, this is all about security selection. It's all about finding those winners and those losers, which means that it's all about active management. That's how you got to approach this market right now.
Jack, just lastly while we have you here, I got about 30 seconds. How is your team at JP Morgan speaking about and talking about the factoring in of a Trump put and a Fed put and the combination of those two factors?
Yeah, well, I mean, these are things that, at least on the Fed side of things, can never be explicitly discussed. It wasn't too long ago that Powell gave that speech and somebody asked, is there a Fed put? And he said no. I mean, what is he supposed to say? Yes? He can't say yes, of course. There's
it's not part of his mandate.
Yeah, it's not. I mean, he can't say, I'm going to step in and save everything all the time, no matter what. I think you have to read between the lines here. And I think if you look at that summary of economic projections from a few weeks ago, the dot plot that came out as part of that March update, the Fed very clearly demonstrated that it is biased toward cutting, even if we head into something of a stagflationary environment. And so I do think that is something that we can lean on as investors, that look, if the consumer really starts to feel the pinch from tariffs or even uncertainty around policy, that the Fed will step in and likely accommodate at least to some extent.
Yeah. Jack, great to see you here this morning. Thanks so much for taking the time.
Thank you, guys.
Absolutely. A slew of economic data is on deck for this week, including GDP, the Fed's preferred inflation gauge, PCE, and the April jobs reports closing out the week on Friday. For a breakdown of what indicators we should be watching, I want to bring in Kathy Bostjancic, who is the nationwide chief economist and senior vice president. Kathy, great to have you back on the program here with us. Just as you're evaluating this data that the Fed is certainly going to be keeping close tabs on here, which do you think the markets should be paying closest attention to, especially within the economic situation and the forecasts that are beginning to prevail because of the impact of tariffs?
Well, good morning, Brad. Happy to be with you. There is a lot of data this week. I would say that the most timely data is most important. So I would really focus on the April data. And the real big release of the week is going to be payrolls on Friday. How's the labor market faring with all of this uncertainty and, threats of tariffs? What we have seen anecdotally is companies have said that they've just basically paused their operations, whether it's investment or hiring. That takes an impact on employment that we'll get on Friday. Now they're stopping short, though, of laying off workers in a very big way, and that's also important. So we'll probably get a soft headline gain of employment. We're looking for 120,000. I think we're just slightly below the consensus expectation, but we think the unemployment rate holds pretty steady at 4.2% for now. We do think in the coming months, the risk is for the unemployment rate to move up more materially and payrolls to weaken substantially. But for now, I think you're just seeing a real big pause in the economy, and that's going to be reflected. Your prior guest talked about the first quarter GDP report. Now, that's old news, but what it symbolizes is that things have just really kind of flattened out here. And that's, again, even before the tariffs. But part of the weakness in Q1 is that we had a huge surge in imports as consumers and businesses tried to get ahead of the tariffs. And interestingly, I think consumer spending was soft, but was stronger than it otherwise would be because people rushed out to buy things like autos and other big ticket items before the tariffs come. So it is going to be several months before we get a real clear picture of how the economy is doing, given the tariffs and all this uncertainty.
Yeah, Kathy, exactly what you're talking about is the thing that I am interested in getting clarity on, because we have had this consumer spending that has been resilient over the past 5 years now. To what extent in the data right now are you able to find clarity on whether the consumer spending is true resiliency versus a pull forward ahead of tariff policy that will then lead to a big fall off in consumer spending?
Yeah, I mean, that's a great question. As you said, the consumers really surprised us the last several years how much they'd be willing to dip into their savings to keep spending. But that was against the backdrop of expectations that the labor market was going to remain quite strong. And now we're seeing cracks, like the consumer confidence report from the conference board on Tuesday. What I'll zero in on is the expectations about the labor market and income. And remember, that survey, 3 of the 5 questions are focused on the labor market, so that's really critical. And I think for the consumer, yeah, they're pulling forward a lot of the spending, and we've seen that all year long, even through early April. So I think the auto sales data we get this week for April probably is inflated. But as you pointed out, if they're pulling it forward, that means they're not spending in the second half of the year. And that's even aside from the price increases, which we think is coming. Price shock is coming. It's in the pipeline. So we think probably like the third quarter is where we get the real downdraft in consumer spending and GDP growth. Beyond that, we'll have to see, what comes out of the White House, what comes out of these trade deals and talks. That could help at least improve sentiment. But I think, unfortunately, there's a lot of, weakness in the system already that will just be playing itself out probably through, the middle part of the summer at least.
How imminently do the impacts of tariffs need to start showing up in the data in order for us to actually see a Fed that cuts multiple times versus just once or twice, which was projected in the back half of this year as we began 2025?
Yeah, another great question. I think it really comes down to the labor market again. I think you've heard from a number of Fed speakers, particularly Fed Governor Waller last week, said if the labor market starts to crack, and I take that as meaning we start to see payroll numbers that are very weak and maybe even negative, and that on a month-to-month basis, and we see the unemployment rate really jumping higher. As he said, a 10th, here and there, increase in unemployment rate is not going to get him alarmed. But if he starts to see a gapping up of the unemployment rate, then they're going to weigh their dual mandate and say, okay, we know inflation, well, we think inflation is going to go up in a meaningful way, but now we're seeing the labor market crater. How do they play that? And by and large, tariffs should be a temporary hit to inflation. The one thing, though, I worry a little bit about is we've seen that the announcement and the enactment of tariffs kind of dragged out. Like, we're still waiting to see if sectoral tariffs come on lumber and copper and semiconductors. Right. That means the inflation impact gets dragged out.
Right. Those sectors, certainly something that we are all waiting for clarity on. Kathy, thank you so much for your time this morning. Appreciate it.
Thank you very much.
Spanish grid operator Red Electrica said it is working to restore power after large parts of Spain and Portugal were hit by a widespread outage on Monday. As of now, it's unclear what caused the sudden blackout. Data from Spain's national grid showing a massive drop in power supply in the Spanish peninsula at the moment of the outage, reportedly around 12:30 p.m. local time. Stock markets continue to operate normally in both countries. Spain's IBEX 35 fell to session lows immediately after the blackout began.
The outages affected major cities, including the capitals of Madrid and Lisbon. Media in both countries reported widespread chaos and disruption to road, rail, and air traffic. Passengers in Madrid and Barcelona are reportedly being evacuated from underground metro systems. We'll continue to bring you coverage as the situation develops. We've got much more ahead on Morning Brief. Now time for some of today's trending tickers. We're watching NVIDIA, Domino's, and IBM. First up, NVIDIA facing increasing competition from China's Huawei. According to the Wall Street Journal, the Chinese tech giant is preparing to test its new AI chip with hopes that it could replace some higher-end NVIDIA products. Shares of NVIDIA, of course, the poster child of the AI semiconductor and chip trade. You're seeing that move lower here. Early pre-market by about 1% here as we inch closer to the beginning of today's trading session.
Yeah, this is a big deal, guys. This could potentially be Huawei's most powerful AI chip yet. And also, according to some sources cited by the Wall Street Journal, this Huawei 910D chip could potentially surpass NVIDIA's 2022 launched H100 in terms of AI performance. So this highlights something that we've been covering a lot, this idea of whether or not export controls start to negatively impact some of these companies like an NVIDIA, where you start to see outperformers in other regions. In this case, of course, that outperformer potentially being Huawei. Also talking about here in some of the analyst commentary reacting to this news, the resilience of China's semiconductor sector despite those export controls, again highlighting the negative impact those export controls could potentially have on some of these names like NVIDIA. We also know from the reporting that Huawei has started approaching Chinese firms to conduct tests on these chips that they are offering potentially moving forward as well. Well, next up, Domino's Pizza missing first quarter revenue estimates hit by a decline in U.S. same-store sales. Still, international same-store sales rose 3.7%, helping to offset the U.S. decline. Those shares down about 1.5%. Really interesting here because Domino's is one of those companies people talk about as a recession indicator, and they say that actually if we are heading toward a downturn, you might see an increase in sales because pizza, that can be one of your little luxuries, your little treats. That's not what we saw in the data, but the company's saying that this is about a slowdown in the consumer and that is why they did have a little bit of that decline here in revenue. Yeah,
a little into the numbers here for Domino's. Revenues increased $27.4 million or 2.5% in the first quarter of 2025. One of the things that comes back to is how they look across their advertising business. In the U.S. franchise advertising revenues, they actually increased primarily, they say, as a result of a decrease in advertising incentives related to certain brand promotions, plus the return to the standard 6% advertising contribution rate at the beginning of the second quarter of 2024. And so that in mind, the increase partially offset by the transitioning of some of their equipment, some of their supplies, ultimately to a third-party seller there. So that just a little bit into the increase in revenue that they were discussing here. And the company's CEO, Russ Weiner, saying that the results demonstrate that their hungry for more strategy continues to drive market share growth in QSR, quick service restaurant pizza, across both their U.S. and international businesses.
Love it.
We got plenty of good pizza options here in New York.
That is true. That is very true.
Hit me with a grandma's slice.
Yes.
All right, finally here, IBM announcing plans to invest a $150 billion figure in America over the next 5 years to accelerate its role in computing. The company's CEO saying the investment ensures that IBM, quote, remains the epicenter of the world's most advanced computing and AI capabilities. Shares of IBM higher pre-market by about 0.4%. I imagine that every time this company hears generative AI or AI and it being some type of new phenomenon, they're just saying, well, hold my beer. Have you guys heard of Watson? Because since we've been in high school, essentially, you've heard and seen them really pounding the pavement about some of their supercomputing and how they can really dovetail that into so many different elements that have had different hype cycles and waves, whether that be in cryptocurrency and blockchain, whether that's been in AI in itself. And so these have been some of the strategic imperatives initiatives that this company has talked about over years now, for the past 7-8 years.
Yeah.
And so now really just trying to invest even further in some of those initiatives.
Yeah, and let's talk about the news of day here. Great to give that context, Brad, in terms of IBM investing in America here. You can see the comparisons with other tech companies here. NVIDIA and Apple both investing up to $500 billion in the United States over the next 4 years, according to their proposals. Now IBM becoming the latest tech company with U.S. investment plans here. This is part of what the Trump administration has been touting off the back of their tariff announcements, the idea that it will lead to an increase in companies investing in the United States, and now the companies that are putting forward that investment, perhaps supporting that idea here. Really quickly, I want to mention this investment includes $30 billion in R&D, focusing on none other than quantum computer manufacturing. We also heard that from NVIDIA. You can scan the QR code to track the best and worst performing stocks with Yahoo Finance's trending tickers page. Still to come here on Morning Brief, we're actually going to talk about Deliveroo soaring today after the British food company received an acquisition offer from DoorDash. The cash offer values the company at about $3.6 billion. Deliveroo says it's suspending a £100 million buyback program announced in March due to the DoorDash bid. You can see those shares of Deliveroo spiking this morning. More when we come back. That is your opening bell this Monday morning. A little bit of a different tenor to it this morning. You've got your New York Stock Exchange and your NASDAQ images live on your screen right now. But let's get you to the market action. It's going to be interesting to see whether the relief rally that was kicked off over the last week can continue. So far this morning, it does look like we may be on track for that. You've got your S&P 500 up just above the flat line here. What's really interesting to note is the degree to which stocks were able to recover over the past week here, off the back of not much news in the form of negotiations, but you still had your S&P up over 7.5% here. If you take a look since that so-called April 2nd Liberation Day that is on your screen here in April, you can see that stocks are down for the S&P 500 by just about 3%, so not as much as they were, of course, when you see those lows on your screen there. And also interesting, I want to take a look at some of your tech names here just for a moment, because it's interesting to see the recovery that we've seen, especially in the Mag 7 names. The Roundhill Mag 7 ETF having its best week ever over the course of the last week. Can that action to the upside continue amid a week where we're going to hear from 40% of your S&P 500 companies? That, of course, is the key question. Let's get it over to Yahoo Finance's Jared Blickery for a broader look at what's moving. Hey, Jared.
Why, thank you, Maddie. Yes, last week I took off. I come back to see it was a very productive rally. We had 3 days up in the middle of the week in the S&P 500 that were up more than 1.5%. The NASDAQ 100 has now clawed back almost 12% of its losses. And let's just get the NASDAQ 100 here, and I will show you the month-to-date chart. And you can see, well, that's not the quite month-to-date chart I was looking at, but let's do a 1-month chart. And you can see just over break even there. So that's very impressive. There are some caveats here I want to point out, and I'm going to put a year-to-date chart on this, and you're going to be able to see that we have climbed right back in to this area where we sold off from. And now we have kind of hit that twice. Can't see it right here, but earlier in April on an intraday basis, we kind of moved up a little bit, almost into that area, but not quite. And the S&P 500, which I'm going to show here, this is also a year-to-date chart. This is looking very similar. We had Zweig breadth thrust, 2 of those last week. That's a very kind of wonky technical thing, and that's where you see a lot of participation in the market, and you get that thrust up. It was an Investor's Business Daily follow-through day, and I know I'm throwing out a lot of terms here, so there's a lot of bullishness, but the bearishness, the potential is that we are right back up into this potential selling area where we have a lot of price memory. A lot of investors were buying the dip in March, and they may be wanting to get their money back at the break-even price, and so that's kind of one of the big market dynamics that we're seeing right now. Want to show you what's going on in the VIX real quickly, and by the way, the bond market and the dollar are just kind of consolidating, not doing a whole lot, so I'm going to skip over them. But the VIX is holding 25. This is another year-to-date chart. It has come down very nicely, but we're still over 20, and that just tells me that there's a lot of uncertainty still baked in the market. As Maddie, as you were saying, there wasn't really a lot of incremental news on the tariffs last week, but I think it was very productive because we were seeing tech leading. The old stalwart of the 2023, 2024 rallies, that would be tech. And let's just see what's cooking early this morning in sector land. Tech is lagging. Tech is in the rear view mirror right here, down about 0.2%. Industrials, financials, and materials are leading, so we got some cyclicals going on there. But overall, looking pretty bearish. And Maddie, you also mentioned the Mag 7, how they just came off their best week ever. I would also note that the Mag 7 now are up 5 straight days. And I want to check out what's going on with the ARK Innovation Fund components. And I'll just give you a 5-day look. Doesn't include all of last week, but look at that. That's a lot of gain. Shopify up 20%, Coinbase up 18%, Roblox up 10%, Hood, that was up 25%. Small caps had a great week. In fact, it was their best week, I believe, since November. So don't quote me on that, but I believe that's true. And I want to venture over to futures land. I said that the US dollar was consolidating. So are a lot of futures right here. I'm seeing that in crude, and I'll show you a crude oil chart. Let me show you a year-to-date, and you can see just how price is kind of coiling right now. And I'm also seeing that in gold. I'm also seeing that in copper. And here is that price action from last week. So basically, we have this pennant formation going on in crude oil, and it's going to look fairly similar, but from an opposite angle in gold. Suffice to say, it looks like we're just coiling for this next move. What's the direction going to be? I think we're going to see commodities and stocks kind of go hand in hand, and so we'll have to figure out who the leader is, who's breaking out of these consolidation patterns through these price memory areas, who's doing that the most convincingly. I'm going to leave us off on crypto, which has had a very productive run since those $75,000 lows. Another year-to-date chart here. You can see there is that low, and we've just rocketed off of those highs. Now we're back into the price memory area of early in the year. So even Bitcoin kind of tracing out some of the same patterns that we're seeing in stocks. So all in all, I'd stay tuned this week.
All right, Jared, we're going to stay tuned indeed. It's just Monday. Thanks so much. Appreciate it. It's time now for today's strategy session. 4 of the Magnificent 7 stocks set to report earnings this week. Meta and Microsoft due out Tuesday. Amazon and Apple set to report Thursday. Joining us now, we've got Dominic Rizzo, who is the Rowe Price Global Technology Fund Portfolio Manager. Great to have you here with us. So I just want to get your expectations and the tone you're expecting from some of these Magnificent 7 names, these components reporting this week.
Well, first off, great to be back, guys. When I'm looking at these Mag 7 names, and frankly, when I'm looking at the broader technology universe, I'm cautiously optimistic heading into this week. What we saw the last couple of weeks of earnings is relative strength across software, semis, internet, and I think that will kind of extend into these Mag 7 names as they're coming up. But it's really all going to come down to fundamentals. I thought the last spot right around where we are from a technical basis is a really great point. This week's really going to determine whether or not last week was just a bear market rally or the start of a new bull market acceleration. And I'm cautiously optimistic that we're going to remain in that bull market.
It's interesting, Dominic, because I was having a conversation with a source over the weekend who talks to a lot of CEOs, and the source was telling me that sometimes CEOs are incentivized to give perhaps a little bit more optimistic picture than is the reality on earnings calls because of the way that analysts will ding them if they don't. So how much can you trust the story that is spun on these earnings calls, especially for the tech names where expectations are so sky high?
Well, if I look at the global technology universe, I actually think expectations have come down quite a bit from where they were in February, right? So if we look at the global technology universe, it's trading at roughly 20 to 21 times earnings today. That peaked in February at 27 to 28 times earnings. And because of the volatility that we saw in April, right, where expectations exactly are is actually pretty tough to gauge heading into this week. But, if we look at valuations, I think they're relatively reasonable. And again, we're at that 20 times level. Historically, we've kind of bottomed at mid-teens, and we would see a good time to sell in 27 to 28. So I think they're relatively okay heading into this week. In terms of how CEOs communicate on their stock earnings calls, I think the great thing about the stock market is it's impossible to trick, right? The market is able to tell if things are getting better or worse, are we going to see accelerating fundamentals or decelerating fundamentals? And I think that was what we saw all last week, right? Take a look at the analog semiconductor names. The companies called the Q1 bottom, and the market believed them. And I think we're going to see some strong follow through in those names.
I wonder, Dominic, from your assessment of these names that we're going to hear from this week, is there one bellwether that could come out and dampen the bounce vibes that we've been tracking over the past few sessions here?
Yeah, I think Microsoft is clearly that bellwether, right? Because if we look at where Microsoft plays, they're such an important player in AI, right? We saw very strong numbers out of SAP. Current cloud backlog grew 29%. ServiceNow grew their subscription revenue 20% for this year. So the big question is, what is that Azure growth number going to be? I think that's very important. And then there's been a lot of questions around what's Microsoft CapEx budget going to look like throughout the year. I'm personally in the camp that, the moves that we've seen Microsoft make is just kind of typical leasing moves that we've seen them adjust as they constantly adjust, particularly as they move away from doing some of the core CapEx for OpenAI. And I still think their CapEx is going to remain really strong. And that CapEx number is so important because it drives NVIDIA's revenue growth, it drives AMD's revenue growth, it drives Broadcom's revenue growth. Outside of those names, I'm looking at auto industrial names, and an area of the market that I'm very bullish on today, and probably the most bullish on, is analog semis, like NXPI, ADI, Infineon.
Well, since previously you had mentioned NVIDIA, I want to go there with Huawei developing that new AI chip looking to compete with NVIDIA potentially moving forward. To what extent do you see that as a headwind and just the China tech competition as a headwind for NVIDIA?
Well, I think the tough part for Huawei is they don't have the best manufacturing process, right? Huawei is stuck with 7nm plus from SMIC in China, and there's nothing they can really do about that because of the restrictions. Where NVIDIA, AMD, Broadcom, we're seeing AMD move to 2 nanometers at TSM. And as we all know in chips, if you don't have the manufacturing process, it's very, very difficult to compete. Of course, you can network different chips together, but having that benefit of having leading edge manufacturing from TSMC is such an advantage for NVIDIA, AMD, Broadcom, et cetera. The way I see the AI chip market playing out over time is actually very similar to the China internet market versus the US internet market, right? The China internet market is really a China for China world. Alibaba, Tencent, they provide all the core services in China, where around the world, the rest of the world uses all US internet, right? Meta, Google, Amazon. And so when I look at that, I kind of see that's actually a very similar setup. Around the world, NVIDIA, AMD, Broadcom are going to dominate. Within China, that's going to be a China for China world. What I like about the setup of the digital semi names is we've now had that China revenue taken out of a lot of the expectations, right? NVIDIA writing off $5.5 billion of cost of goods sold. That translates probably to $15 to $20 billion of revenue. That's coming out of expectations because the H20s can't be sold there anywhere. Same with AMD. We saw a nice write down there of $800 million, probably $1.5 billion in revenue. So all that being said, that means that those numbers are more reset heading into earnings, which I think is a good place from a stock perspective.
Dominic, good to see you this morning. Thanks for taking the time just after the open.
Great seeing you. Talk soon.
It's time now for our chart of the day. Let's send it on over to my co-host, Madison Mills, for a look at the S&P 500's performance during President Trump's first 100 days.
Thank you, Brad. So taking a look at the S&P 500 under Trump's first 100 days in office, you can see the S&P down nearly 8% off the back of a lot of uncertainty around the trade war. But how does this pair with history? Well, let's take a look at the best performing first 100 days. FDR in 1933 up 78%, and then you got Biden in 2021 up 10%. Now, really important context here. These were off of huge market crashes. Obviously, you all remember COVID, and then, of course, a market crash in the early 1930s. So huge recovery and rebound setup for those presidencies. Let's take a look at some of those presidencies, though, where we saw a little bit more weakness. And I want to really zero in on Ford's presidency. Coming in 1974, that was after Nixon's resignation. But that environment has a lot of similarities to the environment we're in today. So down 11.8% in Ford's first 100 days. What was going on then? Stagflation. That is the key concern with where we are currently at. Stagflation, of course, as a reminder, meaning you have inflation, but you also have slowing growth. Also, in both of these backdrops, you have a Federal Reserve that had higher interest rates. Now, the good thing about that is that the Fed can then cut if there is too much weakness in the economy. But in both cases, because you have that stagflation, meaning higher inflation and slowing growth, it's hard for the Fed to justify cutting because there is that inflationary backdrop. And lastly, guys, I actually want to flip back to the best performers if we can for a second, just to remind folks, look at this record-breaking rally here. This is why so many sources that we bring on this show remind investors, especially the less active ones and long-term investors, don't lock in your losses, because if you do, you may be out of the market before you see that double-digit rally. Of course, you wouldn't want to miss out on a 78% rally off of a negative year for the market here. Brad?
Yeah, if only FDR had an NVIDIA. Maddie, thanks so much.
Thank you.
Coming up, we're bringing you the latest on U.S.-China relations amid conflicting messaging on trade negotiations. That's next on Morning Brief. Treasury Secretary Scott Bessent said it's up to China to de-escalate trade tensions between the two nations in an interview with CNBC Monday morning. The comments come amid mixed messaging on negotiations. President Trump said in an earlier interview he'd spoken to China's Xi Jinping recently, and Chinese officials refuted that claim early Monday. Here to discuss, we've got Justin Wolfers, University of Michigan professor of economics and public policy. Good to have you here with us. I mean, the best way that I was describing this with friends over the weekend was it's kind of like if you're in high school and you're trying to tell your friends, like, hey, yeah, me and that person, yeah, we talk. We're trying to see where things go. And then somebody else coming out and say, yeah, no, we don't talk. We're not even acquaintances, or we're not at any juncture to negotiate being friends. So where are we at, and how are you making sense of this?
Look, let's stick with high school, and I'm going to give you the best dad joke I've thought of all day. The problem facing the United States right now is, wait for it, she won't call. Yes, Trump is acting probably a little less maturely than I did when I was 15 and hoping she would call. Look, there's one part you can laugh about this. He's saying that she keeps calling. She denies it. One of them is an inveterate liar. The other is leading one of the world's largest economies. But the real shame, and the thing that makes this very different than high school, is when she won't call in high school, my social life is on hold. Here, what's happening is Trump is imposing 145% tariffs on Americans, effectively cutting them off from an important and needed source of inputs for production of goods that we consume. Our supply chains are integrally linked, and he's just smashed that up while he sits by the phone.
I want to talk to you, Justin, about something that the president posted on Truth Social this weekend and reiterated in interviews. He talked about this idea of cutting income taxes on Truth Social, saying taxes will be substantially reduced, maybe even completely eliminated, especially for those making under $200,000 a year. To what extent, Justin, is the market discounting a potential cut to taxes, a potential cut to income taxes that could lead to some type of rebound in consumer spending and therefore a lift in the stock market? How much do you buy the sweetener of tax cuts coming?
Look, the president's lying. It's that simple. There's no bill, there's no process, there's no proposal, there's nothing that's gone up to Congress. But more importantly than that, there's a fundamental incoherence. He says in that Truth Social post, I'm going to get so much revenue that I can cut your taxes. In order to get revenue, we have to keep tariffs high. He also says over the weekend, I'm meeting with Xi talking about reducing tariffs. If he makes deals, which apparently is what he's recently been claiming is the goal for his administration, those deals will be to reduce tariffs. If that's the case, the tariff revenue will be awfully close to zero. So the president's got a choice: make deals, which gives American businesses access to a global market and gives Americans access to purchase stuff from all over the world, or stick with very high tariffs and get some revenue out of it at least. You cannot have both. It's incoherent. And that's the problem with this whole tariff policy. What the president wants has changed from day to day. Is it about national defense? Is it about onshoring manufacturing? Is it about raising revenues? Is it about making deals? Mm-hmm. Is it about... it changes. Mm-hmm. And the problem is, if you had different objectives, that would lead you towards different types of tariff policies. And what we have instead is an incoherent mix of all of the above. But more importantly, businesses need to plan for the future.
Right.
Our foreign partners need to know how to or whether to negotiate with this White House.
So Justin,
if Trump's out there saying, I'm going to get tons of revenue, then he's saying, I'm not making a deal. So why should they even turn up to negotiate?
So let's dig into what you're saying, though, because there is that reconciliation bill that does include the potential extension of tax cuts that were already in place, to your point. But Treasury Secretary Scott Bessent told our network...
Wait. That bill has nothing to do with tax cuts for working and middle-class Americans,
No,
which is what the president promised.
I know that.
Bill
Justin,
is tax cuts for the rich.
So... Well, talk to me about this. Treasury Secretary Scott Bessent telling our network that tax cuts and deregulation from the administration is being discounted by investors. What is your reaction to that?
Investors are responding to nothing but chaos because that's all Besant's giving us. Look, if you can figure out what they're doing, then you're far better at this game than me. But I've been reading everything that's come out of the administration. They can't tell us what tariffs are for. They can't tell us what revenues they're going to get. And they're in the midst of trying to have a budget-busting bill while at the same time we're looking at US bonds being sold off around the world. It's incoherent.
And so with that barrage of information that has continued to come out of the White House, what do you believe the continued net impact will be on the consumer, and how will that pass through to what businesses are both forecasting and their reaction function of what's playing out?
Yeah, so if you look at any survey of what Americans think, how they're feeling about the economy, they're feeling miserable. We haven't seen consumer confidence fall as far or as fast as it has over the last 2 months. We've seen expectations of the unemployment rate skyrocket. We've seen expectations of inflation skyrocket. We've seen business confidence plummet. And so what does that mean? It means that I think most families are sitting around the table worried about the future of the economy. This is a conversation no family was having 3 months ago, but now they're like, if there's a recession, how should we act? Well, when you start worrying about that, then you start thinking, well, maybe I'll put off maybe I should save some money for a rainy day. And if that's the case, instead of making a big purchase, I'm going to hold my money tight, which means spending dries up. And if consumer spending dries up, that is the first domino that falls in creating the next recession.
Justin, thanks so much for taking the time here with us this morning. A lot of econ data to digest over the course of this week. We'd love to check back in the future.
A pleasure, mate.
All your markets action straight ahead. Stay tuned. You're watching the Morning Brief. We're taking a closer look at some trending tickers this morning, and we're doing it in 30 seconds each. We're looking at Boeing, Jack in the Box, and Eli Lilly. First up, Boeing raised to outperform from market perform at Bernstein. The firm says the plane maker is, quote, making the progress it needed for the growth trajectory. The analysts maintain that they cannot assume all risks are gone, but that the company should be on a better path now after increased scrutiny. Bernstein set its price target on the stock to $218, 23% upside from the stock's last close.
Plus, Jack in the Box upgraded to buy from hold at Stifel. The firm touting the fast food chain's new CEO, Lance Tucker, saying Tucker, quote, has created a viable plan to strengthen the balance sheet. The analyst says Jack in the Box's decision to close a couple hundred underperforming units puts it in a stronger competitive position. The firm set a $32 price target, 31% upside from the stock's last close.
And finally, Eli Lilly getting a double downgrade from HSBC to reduce the equivalent of a sell rating from buy. The firm says Lilly's price target, or the risk reward rather, is, quote, not attractive. And the analysts think that the market may be overstating or overestimating perhaps Lilly's market share, and that uncertainties in the economy may pressure demand for GLP-1s. The firm also has concerns around Lilly's new weight loss drug. HSBC reducing its price target to $700. That represents 21% downside from the stock's last close.
Quite a call there. All right, you can scan the QR code below to track the best and worst performing stocks with Yahoo Finance's trending tickers page. That's going to do it for the Morning Brief. You can join me in the next hour for more analysis on Catalyst, and then Brad for Wealth after that. Stick around.